I want to start with a question, not a rhetorical one, a real one that I've been sitting with all week. What if the people who are most confident that these tariffs will work have never actually looked at what happened the last time America tried exactly this? Because I pulled the history. I went back to 1928, 1929, 1930. I read the Economist petitions and the congressional transcripts and the trade data, and what I found is something I genuinely wasn't expecting. Not because the history is obscure, but because the parallel to March 2026 is so precise, so step-by-step identical, that it doesn't feel like a historical comparison anymore. It feels like a playbook, a documented, time-stamped playbook for how this sequence unfolds, what it does to the economy, and this is the part I need you to stay for, what it does to the geopolitical order when it's over. Here's what I'm going to show you. I'm going to walk you through the exact sequence of events that started in 1928 and culminated in the Great Depression and the political destabilization of Europe. And then I'm going to show you where we are in that same sequence right now, in March 2026, beat for beat. And I'm going to give you the specific leading indicators I'm tracking that will tell us whether this breaks from the historical pattern or confirms it. Because here's the thing, trade wars don't announce themselves with a single crash. They erode slowly, then all at once. And the people who see it coming are the ones who understood the pattern before the crowd did. Let me show you what I found. The 1928 setup and why it sounds exactly like 2024. Let me take you back to 1928, because this is where the pattern starts. And I need you to hear this with fresh ears, because I think the familiarity of it is going to be uncomfortable. A Republican is running for President of the United States. The economy looks strong on the surface, stock market at record highs, consumer confidence elevated, unemployment low. But underneath that surface, a specific constituency is being left behind. Rural America, farmers, the people working in industries that are getting squeezed by foreign competition and falling prices. Global agricultural production has outpaced demand. Farm income is declining, and this Republican candidate sees the political opening. His campaign promise: raise tariffs on agricultural imports, protect American farmers from foreign competition, put America first economically. The crowds love it. He wins in a landslide. His name is Herbert Hoover. I need you to sit with how completely that description maps onto 2024. I'm not making a partisan point, I'm making a structural one. The political logic that got Smoot-Hawley passed wasn't unique to 1930. It's a recurring pattern in American economic nationalism. Identify a struggling constituency, promise protection through tariffs, win the election, then implement the policy. The political incentives are identical across the century, which is why the outcome tends to be identical too. Hoover takes office in 1929. He calls a special session of Congress to address the farm problem. And here's the first thing I want to flag, the thing that history textbooks underemphasize, because it's the mechanism that turns a targeted agricultural tariff into the largest trade disaster in modern American history. Once the tariff revision process opened, it became impossible to contain. Lobbyists flooded Washington, industries far beyond agriculture, wool, sugar, machinery, chemicals, steel, textiles, glass, all demanded their own protections. Congressional members traded votes. A bill designed to help farmers expanded to cover tariff increases on over 20,000 imported goods, the largest tariff increase in modern American history. A bill that started as agricultural protection became a comprehensive assault on global trade. They called it the Smoot-Hawley Tariff Act. And before I show you what it did, I need to show you something that's been haunting me since I pulled the research. The warning that was ignored, and the one being ignored now. In May 1930, before Hoover had signed the bill, over 1,000 American economists signed a public petition begging him to veto it. 1,000 economists. That's not a fringe academic opinion. That's the profession reaching consensus in public. Henry Ford, one of the most powerful industrialists in America, a man with direct access to the Oval Office, went to the White House personally to argue against it. He called it an economic catastrophe in the making. Thomas Lamont, the chief executive of J.P. Morgan, later wrote that he had almost gone on his knees to beg Hoover not to sign the bill. J.P. Morgan, begging the president not to sign a tariff. The business community, the academic economics community, the global trading partners who were already warning of retaliation, every signal was pointing the same direction. Don't do this. Hoover signed it on June 17, 1930. The day before he announced he would sign it, the stock market lost $1 billion in a single session. Now let me show you the 2025-2026 version of this exact scene. In January 2025, Nobel laureate economist Joseph Stiglitz said publicly, and I'm going to give you his words because they deserve to be heard directly, virtually all economists think the impact of the tariffs will be very bad for America and for the world. Virtually all. The CEOs of Ford, General Motors and Stellantis immediately lobbied the White House for automobile exemptions the day after tariffs were announced. The same industries that were screaming in 1930 are screaming in 2026 with different logos on the letterhead. The pattern of warning is identical. The pattern of partial listening and eventual imposition is identical. And the political logic overriding the economic warnings is identical. Here's what I'm tracking on the 2026 warning signal specifically. The Tax Foundation estimates the current US tariff structure represents the largest American tax increase as a percentage of GDP since 1993. Not a corporate tax, a consumption tax, a tax on what you buy. Their estimate, $500 per American household in 2026 alone. Conservative estimate in their own framing if escalation continues. I've seen other models at $1,500, $2,000 if the full tariff schedule lands on North American trade without exemptions. What I need you to notice is not any single number, it's the direction and the mechanism. Tariffs are not paid by foreign exporters, they are paid by American importers, which means they are paid ultimately by American consumers and American businesses that use imported inputs. When you put a 25% tariff on Canadian steel, American auto manufacturers pay more for steel, American construction companies pay more for materials, and they pass those costs forward to you. This is not economic theory, this is the documented history of every major tariff escalation in the modern era. It taxes the domestic consumer to protect the domestic producer. And when the protected producer depends on inputs from the same trading partners you're taxing, it frequently hurts the very industries it's designed to protect. The Canada parallel. This is where it gets eerie. Let me show you the specific Canadian comparison, because this is where the historical parallel stops being interesting and starts being alarming. In 1930, Canada was then, as it is now, the United States' single largest trading partner, and Canada's reaction to Smoot-Hawley was immediate and specific. Even before Hoover signed the act, Canada imposed retaliatory tariffs on 16 categories of American goods that represented approximately 30% of US exports to Canada. American farmers lost Canadian markets for their products. American manufacturers lost Canadian customers for their exports. But here's the part that people in 1930 didn't see coming, and that I think people in 2026 are underestimating right now. Canada didn't just retaliate economically, Canada pivoted geopolitically. They forged closer economic ties with the British Empire. They found alternative relationships. A country that had been deeply economically intertwined with the United States, a country that shared a border, shared a language, shared a century of integration, turned toward other partners because the economic attack from their closest ally made diversification an existential necessity. Now look at March 2026. On March 4, 2026, the United States imposed 25% tariffs on Canadian goods. Canada's response began within hours. Retaliatory tariffs on American products. Canadian provinces removing American alcohol from store shelves, Ontario cancelling a $100 million contract with an American company, and Prime Minister Mark Carney, a former central banker, someone who has studied economic history more rigorously than virtually any other sitting political leader, made a statement that I need you to hear as the geopolitical alarm it actually is. Carney publicly declared that the era of close economic integration and security cooperation with the United States has ended. He called on Canadians to fundamentally reimagine their economy, to dramatically reduce dependence on the United States. In 1930, Canada pivoted toward the British Empire. In 2026, Canada is pivoting toward China. Let me sit with that for a moment, because I think the implications are being underpriced in almost every conversation I'm seeing. America's closest ally, the country that shares the world's longest undefended border with the United States, the country that sends 60% of its crude oil exports to America, the country that has been economically integrated with the US since before either nation fully industrialized, is now actively pursuing closer economic ties with Beijing. In January 2026, Trump threatened Canada with 100% tariffs if it finalized a trade deal with China. Canada is pursuing that relationship anyway. That is not a trade headline. That is a generational geopolitical realignment, and it is a direct consequence of tariff escalation following the exact same logic as 1930. The collapse sequence. What the history says happens next. Here's the sequence I need you to understand, because this is the documented playbook from 1930, and this is what I'm tracking in real time in 2026. Step 1. Retaliation begins, starting with Canada. Check. Happened in 1930. Happening in 2026. Step 2. Other countries follow. In 1930, within months of Smoot-Hawley, over 25 nations had enacted retaliatory tariffs against the United States. American exports fell from $7 billion in 1929 to $2.5 billion in 1932, a 64% decline, not a slowdown, a collapse. And here's the specific thing I need you to track because most people miss it. Agricultural exports, the sector that Smoot-Hawley was designed to protect, fell by 1/3. The farmers who were supposed to benefit from the tariffs were devastated by the retaliatory tariffs on American exports. Because here's the thing about agricultural exports. They are entirely dependent on foreign markets buying American goods. When you start a trade war, those markets close. Every time. The farmers lose every time. Where are we in 2026? American farmers exporting to Canada, orange juice, soybeans, agricultural equipment, are now facing Canadian retaliatory tariffs. The Smoot-Hawley pattern activated on agricultural exporters almost immediately. I'm watching the USDA export data weekly. If grain and soy export volumes to Canada and Mexico begin declining significantly in April and May, Step 2 of the 1930 sequence is confirming. Step 3, world trade collapses. Between 1929 and 1934, world trade contracted by 65%. This is not a metaphor or an economist's abstraction. It was a real collapse in the physical movement of goods across borders. Factories that depended on export markets lost them. Supply chains that depended on imported inputs got severed. The economic complexity that creates prosperity in modern industrial economies got unwound violently. Step 4, banks fail, businesses close, unemployment explodes. Unemployment was 8% when Hoover signed Smoot-Hawley. Within 2 years, it was 25%. More than 5,000 American banks failed. Hundreds of thousands of Americans lost their homes. They built shanty towns they called Hoovervilles, tent cities named after the president who signed the bill. The Great Depression was already beginning when Smoot-Hawley passed, but the economists who have studied this period don't debate whether the tariffs made it worse. They debate only how much worse. The consensus is, significantly, meaningfully. A crisis that might have been severe was made catastrophic by trade policy. And then there's the observation that I want to be careful with because it carries enormous moral weight, but it belongs in this analysis. The economic devastation that Smoot-Hawley helped deepen didn't stay in America. It cascaded through European economies that were still recovering from World War I. Economies under severe stress produced political extremism. The catastrophic economic conditions of the early 1930s are now studied seriously as one of the enabling conditions for the rise of fascism in Germany. Trade policy, tariffs. These are not small stakes decisions. The last time America did this at this scale, one of the downstream consequences, through a chain of economic causation, was World War II. I'm not drawing a direct line from March 2026 to a comparable catastrophe. I'm telling you this is the stakes category we're discussing when we talk about major trade war escalation, not recession versus growth, not 2% inflation versus 3%, the historical consequences category. The 2026 divergence, where this is different and whether different means better. Here's where I want to push back on my own historical comparison because intellectual honesty requires it. And here's where it gets complicated. There are real differences between 1930 and 2026. I've been tracking them carefully because they matter for calibrating what comes next. In 1930, the Supreme Court did not strike down Smoot-Hawley. Congress passed it, the president signed it, and the policy was settled. In February 2026, the US Supreme Court struck down Trump's tariffs imposed under IEEPA, the International Emergency Economic Powers Act, ruling that the president had exceeded his authority. The president responded by signing new executive orders, reimposing tariffs through different legal mechanisms. There are multiple ongoing legal challenges. Different courts are reaching different conclusions. The policy is simultaneously tariffs, exemptions, reimpositions, legal challenges, rollbacks, and re-escalations, all within weeks of each other. I want to be very precise about what this means economically, not legally, economically. Markets hate uncertainty. Businesses planning capital investment, supply chain decisions, hiring, They cannot operate rationally when the trade policy environment is in simultaneous legal flux. Even if the ultimate tariff level ends up being identical to what was proposed, the uncertainty itself is an economic cost. Investment freezes. Planning horizons compress. Supply chain adaptation, which requires long lead times and significant capital commitment, gets deferred. That deferral is a drag on economic activity before a single tariff dollar is collected or a single factory is disrupted. The legal complexity is not a safety valve. It's an additional layer of damage on top of the tariff damage. The second difference is the fiscal starting point, and this is the one that concerns me most. In 1930, the United States had no significant federal debt in modern terms. When the New Deal came, FDR's fiscal response to the Depression, the government could spend aggressively because the debt capacity was there. The 1934 Reciprocal Trade Agreements Act that began reversing the tariff damage took 4 years of depression to generate the political will. But when it came in a fiscal context where aggressive response was possible. In 2026, the United States enters this trade escalation with $36 trillion in federal debt. Annual interest payments exceeding $1 trillion. A Federal Reserve that cannot cut rates aggressively because core inflation remains sticky above 2.8%. A corporate sector facing a refinancing wall, trillions in debt issued at near zero rates in 2020-2021, now rolling over at 5% and 6%. The structural vulnerability going into a potential trade war-induced recession is categorically different from 1930. The fiscal response capacity is constrained. The monetary policy response capacity is constrained. The corporate balance sheet resilience is constrained. In 1930, you had a bad policy decision hitting a weakened but still intact economic structure. In 2026, you have a bad policy decision hitting a structure that's already under significant pre-existing stress. That doesn't mean the outcome is necessarily worse, but it means the buffers that might have absorbed the shock are smaller. Where we are in the sequence, the leading indicators I'm tracking. Here's the analytical framework I've built for monitoring this in real time, because that's what this breakdown is actually for. Not historical understanding for its own sake, historical understanding as a predictive tool. The 1930 sequence ran: tariffs, retaliation, trade volume decline, agricultural sector pain, small business failures, banking stress, unemployment spike, depression deepening. The full sequence took approximately 18 to 24 months from tariff signing to full economic impact. This is crucial. Trade wars don't look like crashes. They look like gradual economic degradation that becomes undeniable only when the unemployment data arrives, which is always lagging. So what I'm watching for the next 90 days as early confirmation or denial of the historical pattern. Indicator 1. Canadian and Mexican export data to the US. If bilateral trade volumes begin declining significantly, not just month-to-month noise but trend confirmation, supply chain disruption is beginning. I'm watching this monthly. The March and April numbers will be the first real signal. If they're down 5% or more from pre-tariff levels, the 1930 trade volume collapse pattern is activating. Indicator 2. Agricultural commodity prices and export volumes. Tariff retaliation historically hits farmers first and hardest. For the reason I described, their revenue is entirely export dependent. If I see significant movement in soybean, grain, or corn export volumes to Canada and Mexico, or if the American Farm Bureau starts releasing distress data, the 1930 agricultural pattern is confirming. This is the signal with the most historical precision. Indicator 3. NFIB Small Business Confidence Index. In 1930, small businesses were the first to fail. They couldn't absorb input cost increases the way large corporations could. They couldn't negotiate volume discounts. They couldn't hedge through financial instruments. They just paid more and made less until they couldn't. The NFIB data is the modern equivalent of what the 1930 small business failure data would have looked like if we'd measured it. I'm watching for confidence dropping below 90, which has historically correlated with elevated small business failure rates. Indicator 4. USMCA renegotiation timeline. This is the single most important structural indicator I'm tracking. The 2026 USMCA review was already scheduled. If that renegotiation collapses, if the parties cannot reach agreement and the existing framework expires without renewal, the current partial exemptions on North American trade disappear. The full tariff structure falls on Canadian, Mexican, and American trade simultaneously. That is the moment the slow burn becomes an acute crisis. That is the moment the 1930 parallel goes from tracking to accelerating. Indicator 5. Fed rate trajectory against inflation expectations. Here's the constraint I keep coming back to. If tariffs are inflationary, and they are mechanically because they raise import prices, and if inflation expectations rise because of tariff-driven price increases, the Fed cannot cut rates to stimulate the economy even if growth slows. They face a stagflation constraint, slowing growth and sticky inflation simultaneously, unable to address one without worsening the other. This is different from 1930 but potentially as dangerous. I'm watching 5-year break-even inflation rates in the Treasury market as the real-time measure of where inflation expectations are moving. What this means for your portfolio. The asymmetric positioning. Let me get specific about what the historical pattern implies for positioning, because that's why understanding this history matters practically. First, the inflation impact on household budgets is already beginning and is going to accelerate. The Tax Foundation's $500 per household estimate assumes the current tariff schedule. If escalation continues, if Canada responds more aggressively, if other trading partners join the retaliation, if the USMCA framework breaks down, I've seen responsible models at $1,500 to $2,000 per household annually. This isn't market risk in the abstract. This is your grocery bill, your gas price, your car payment, the price of anything with an import component, which is most manufactured goods. Second, the sector-level risk asymmetry. What I found when I mapped the 1930 sector impacts onto the current economy is that the most damaged sectors were the ones most dependent on either export markets or imported inputs. In 2026, the clearest elevated risk categories are automotive manufacturers with North American supply chain integration, agricultural exporters dependent on Canadian and Mexican market access, and any company with significant cross-border supply chain exposure where tariffs are landing on inputs rather than finished goods. These are not opinions. These are sectors where the tariff mechanism creates margin compression that their earnings models aren't currently pricing. The sectors that held better in 1930, and the structural parallel holds, were domestic-oriented businesses with pricing power, companies that could raise prices because they faced limited import competition and served domestic markets. Defense was essentially irrelevant as a sector then. It's clearly different now. Consumer staples with domestic supply chains, energy producers in the domestic market, infrastructure-oriented businesses. Third, the gold argument, and I want to make this carefully because I think the lazy version of this claim undersells the actual mechanism. In the 1930s, gold wasn't a safe haven asset in the portfolio construction sense. Gold was the monetary system. Bretton Woods hadn't happened yet, currencies were still gold-backed. The mechanism in 2026 is different but directionally similar. When governments weaponize their currencies through trade policy, when dollar relationships become politically contingent, when allies are treated as adversaries, when the global trading system that the dollar as reserve currency underwrites starts fragmenting, the premium on stateless money goes up. Gold doesn't have a central bank. Gold doesn't have a sanction regime. Gold doesn't have a tariff. Every trade war in the modern era has produced gold appreciation as the instrument for pricing out-of-system risk. This one is following the same pattern. Gold crossed $3,300 per ounce this year. That's not inflation speculation, that's global dollar confidence repricing. What I'm watching on gold specifically, if central bank gold purchases, which I'm tracking through World Gold Council data, continue accelerating through Q2, that's the sovereign level read that official institutions are hedging dollar system integrity risk. That data has been directionally clear for 18 months. It's not reversing. The bull case, and why I don't find it convincing. Let me do something the style of analysis I'm known for requires. Present the strongest case that the 1930 parallel is wrong, and this ends better, because you deserve to hear it and evaluate it, not just hear confirmation of the bearish thesis. The bull case has 3 pillars. First, negotiating leverage. The 1930 tariffs weren't designed as negotiating tools. They were designed as permanent protections. In 2026, the Trump administration has been explicit that tariffs are leverage for deal-making. If they work as leverage, if Canada, Mexico, China concede enough that the tariffs come down quickly, the economic damage is limited and the strategic objective is achieved. This is not impossible. Deals do get made. The threat itself can produce concessions. Second, the legal uncertainty cuts both ways. Yes, market uncertainty is economically damaging. But the legal challenges also mean the policy is potentially reversible faster than 1930. Smoot-Hawley required an act of Congress to undo. The 1934 Reciprocal Trade Agreements Act took 4 years and a new president. If the Supreme Court challenges ultimately succeed in limiting executive tariff authority, the policy could unwind faster than the historical parallel suggests. Third, the global economy is more interconnected than 1930, which cuts both ways. More interconnection means tariffs cause more disruption. But it also means the pressure to resolve disputes is higher. Canada cannot easily replace the US market. They send 75% of their exports to America. China cannot easily replace American consumption demand. The mutual dependency that makes trade wars painful also creates mutual incentives for resolution. Here's why I find the bull case insufficient, even after taking it seriously. On negotiating leverage, the 1930 precedent is precisely about what happens when leverage logic collides with political dignity. Canada in 1930 didn't negotiate. They retaliated and pivoted. Mark Carney is not running toward a deal. He's running an election on being the Prime Minister who stood up to American economic bullying. The political incentives for Canadian leadership to capitulate quickly don't exist. And Canada's pivot toward China, once it begins in earnest, doesn't reverse easily, even if the tariffs eventually come down. On legal reversibility, the executive order mechanism, once the legal pathway is established, creates ongoing policy uncertainty even after resolution. Every future president knows this tool exists and is usable. That changes the permanent risk premium businesses assigned to cross-border investment. That's a lasting structural cost even in a resolution scenario. On mutual dependency, yes, the mutual dependency creates resolution pressure, but it creates it symmetrically, which means both sides have incentive to hold out for better terms, which means the resolution timeline is long, and the damage in the interim is real and compounds. The historical parallel doesn't require the endpoint to be identical to 1930. It requires the mechanism to be identical. And the mechanism, tariff escalation, retaliation, trade volume decline, sector-level damage, fiscal constraint, limiting response capacity, is tracking with the 1930 sequence in ways that demand serious attention, regardless of how the ultimate resolution looks. The question history is asking us. I've been sitting with one question all week that I want to put directly to you, and then I'm going to close. In May 1930, over 1,000 economists signed a public petition begging Herbert Hoover not to sign the Smoot-Hawley Act. Henry Ford begged him not to sign it. J.P. Morgan's chief executive begged him not to sign it. The stock market fell $1 billion the day before he announced he would sign it. He signed it. The result, the deepening of the Great Depression, a 65% collapse in world trade, unemployment hitting 25% in America, the destabilization of European economies, conditions that historians now study as enabling factors for the rise of fascism and the eventual outbreak of World War II. Not because anyone planned that chain of events, not because anyone wanted those outcomes, because the political logic of economic nationalism, once activated, proved more powerful than the economic warnings against it. Because the lobbyists who wanted protection were louder than the economists who understood the mechanism. Because the president signed what his political coalition demanded rather than what the data said. In January 2025, Joseph Stiglitz, Nobel laureate economist, said that virtually all economists believe the tariffs will be very bad for America and for the world. The CEOs of every major American automaker lobbied the White House for exemptions the day the policy landed. The economists are louder now than they were in 1930. The business warnings are arriving faster. The historical record is more thoroughly documented. The 1930 playbook is in every economics textbook. And on March 4, 2026, 25% tariffs went on Canadian goods. Canada responded within hours. So here's the question I want you to answer in the comments, and I mean this genuinely because the answer matters for how I think about the next phase of this analysis. Do you think the outcome will be different this time? And if yes, what specifically is different enough to break the pattern? I've given you my read on the bull case. I want to hear yours. What history is actually for? Let me close with the thing I believe most directly about why understanding this history matters for you, specifically financially, right now. The people who protected their wealth in 1929 to 1932 were not the ones who predicted the exact depth or duration of the Depression. They were the ones who understood the mechanism early enough to act before the crowd, who reduced their exposure to sectors most vulnerable to trade war dynamics, who held real assets when currencies were under pressure, who maintained liquidity when credit contracted, who didn't need to sell at the bottom because they weren't caught fully exposed when the bottom came. Understanding the Smoot-Hawley sequence doesn't tell you the exact date when the next critical data point lands. It tells you the direction of the mechanism and the sectors that get hit first. It gives you the leading indicators: agricultural export data, small business confidence, USMCA timeline, bilateral trade volumes, that confirm or deny the thesis before the lagging indicators like unemployment make it undeniable. What I'm watching in the next 90 days: the April bilateral trade data between the US and Canada, the NFIB April confidence number, any movement on USMCA renegotiation talks, the agricultural export data for Q1 2026, and the Gold Central Bank purchasing data for Q1. If those indicators track the historical pattern, I'll be back with the next data point and the next step in the analysis. If they diverge, if the negotiation scenario produces a rapid de-escalation, I'll tell you that too, because this is not about a predetermined conclusion. It's about following the data through the lens of documented history. The system has rules. The rules don't change because the year number changes. Smoot-Hawley wasn't an accident. It was the predictable output of political incentives that overrode economic logic in a pattern that has repeated throughout history. The question is not whether you know the history. The question is whether you know it early enough to matter. I'm watching the indicators. I'll be back with the data. This is Andrew John. The 1930 playbook is in motion. Now you know what to watch.